We went over last Wednesday. We covered the lecture notes. We started the homework package, the class package, but we were able to finish. We didn't even finish one, so I'm going to continue it for today. So if you this is what we were the last time we met. We went over to this one here. This is what we want to. Please, do you guys see my screen?
Yes.
So we
Yes.
went we went over the lecture note, then we did a class exercise estimating of the potential goodwill and also how much the price that this person is willing to pay, the company is willing to pay to get the other company. And we mentioned that there's a 6 steps that you have to go through to determine or calculate the goodwill. So one is the what? Number one, we said find the similar company percentage, which is the first step. And step two, multiply it by the what? The net identifiable assets of the target company that you are trying to acquire. And that will tell you that how much the similar company in the market are earning every year with the company that you want to buy. So we did that one, step one and two, we did together, and we found out that this is the similar in the similar market. This is the income the company is having. So if you want to buy the AT&T, the similar company in the market is the what? T-Mobile and the Verizon. So when you find the percentage of the net asset of the similar company is 465,000 of the normal earnings they are going to get, then you have to go through your calculation and see whether it's worth it. It's good to buy this company or maybe leave this company alone. So we said first one, you have to calculate our expected earnings. So we went through the 2017, the pre-tax before the any other adjustment was 7.5 mil. I think it was 600,000. So we took the 600,000. We adjust with the depreciation. Why? Because we were told on the note here, on the note right here, that the asset include office equipment with a word, a fair value, approximately book value, burden with the fair value of 30% of higher than the book value, which simply means that when it comes to the burden, apart from the normal every year, their normal depreciation, you have to top it up 30% every year of their normal depreciation. So you're going to provide additional 30% of the normal depreciation of the what? Of the company. The normal depreciation of the what? The company. And we went through that. What we did is that we took the depreciation on the burden of the 430, we multiply by 30%. That give us the what? 144. We subtracted it from the what? The predetermined or pre-income tax. That give us the what? The adjusted income, adjusted amount, or the actual amount we are going to get after we take out the what? The depreciation is going to give us that earnings. Then we want to year two or the 2028, 18, with the pre-income tax was given as what? 750 right here. Then we subtracted the depreciation, additional depreciation every year of the 30%. That give us the what? The adjusted earnings and amount of the what? The 2018 of the what? 606. Then we did the 2019, which is the what? Pre-tax income was 475. We provided a what? But what happened is right here. There were a loss that we had to, they were deducted. So we are going to add it back. So we added the extraordinary loss. You guys did the intermediate accounting too, so you know what extraordinary loss is, right? It's unusual losses. Unusual losses. For example, in New York, we don't live in the area where there's always flood, right? But it is, if it's happened, it's unusual. to happen in New York. So that's 150,000. We added and we subtract the depreciation of the 30% additional depreciation. After that, what we did that we add the numbers together. We added all the numbers together, and then the target earning for the 3 years. So in the 3 years, this is how much we think that we are going to earn in the 3 years. So the next thing we have to determine is that what is the average earning in the average of the 3 years? What will be the average earning for the 3 years? So we are going to take this here.
Yeah. Why we end up extraordinary loss?
Which the extraordinary loss here was right here. You see here in the 2019, the company think that they lost a loss. The loss was due to the extraordinary loss. The typical example, like what I gave, right? That in New York, there's no flood, right? Rain and the hurricane or whatever to cause any fraud in the company. So if it's something like that happen to the company, it means that it's not a regular loss that they normally lose. It's something that's extraordinary. Therefore, we are adding it back to get the actual net income or actual income before the loss. Does that make sense, Fatima?
Yes, Professor.
Okay. So now we are going to take the total of the 3 years, which is amount of 1,543,000 divided by 3 years, because this is for 3 years. This average is for 3 years. We are trying to look at averagely, what are we going to get average in every year? So what will be the average here? You need the average amount here. So those with the calculator, I can do it somewhere here. This is equals to this, or somebody put it already or not, or somebody put, let me try to see, divided by 3. So let's see if you can get the same as what you have. Somebody put it, let's see if it's the same. Okay, so averagely, this is what you are saying. If I buy this company today or this year, every year I'm going to earn this amount. Every year I'm going to earn this amount. Remember that step 5 said compare the normal earning of the company to your earning every year. So therefore, we are now going to take this one is equal to our excess earning we are going to get is equal to the 54514.33 here. So let's make it 333. Let's forget about the extra point here. And then less the average of 465 here. So averagely, when you buy this company, this is the excess money you are going to get. You need excess money, which is equals to I'm trying to for you this minus this one here. So averagely, when you buy this company, this is what you are going to get as a per year. You are going to get this money per year as excess money, extra earnings you are getting because I just want to remove this sensor. Because there's an extra money you are going to get when you buy this company, which is good. Why? Because you are going to earn more than the regular market. How much similar companies are earning in the market? Any question before you continue? The floor is open. This is extra money that you are going to get. That doesn't mean that this is your goodwill. This is your extra money you are going to get every single year. Any questions before I continue? Before we answer, still we have not answered the question. Now we are going to answer the A and the B together. Now A is, what if, assuming that plantation home field that it must earn 25% return on its investment, and that goodwill is what determined as what? Capitalized excess earnings. We are going to capitalize its excess earning indefinitely. That is what we mean, 25%. So to get the goodwill here, we are going to take this amount here. So this is equals to the 20, this one here divided by 0.25%. So 0.25%. So this is what actually you are saying, that this is your goodwill. As a matter of fact, this is the amount of the goodwill. The extra money that you are paying is this amount. So this is the estimated goodwill. Extra money you are going to pay in order to get a company. This is the goodwill. Extra money you are willing to pay in order to get the company. You are willing to pay extra money of this amount as a goodwill. Therefore, how much are you willing to pay? Now, this formula here is equal to your the net identifiable assets, which is the difference between these two here. So this one is equals to 7.5 million minus the 4.4 million plus the goodwill, plus your goodwill that you want to pay, plus the goodwill which is estimated as a 197,333 here. That is the goodwill here. This is how much the goodwill that you are willing to pay. So let me see if I can bring this lady here. Good. So when you add this, you subtract these two numbers and you add this one, I think it's going to give you, those with the calculator, it's going to give you 3,297,333. So this is how much you are willing to pay for the company. This is how much you are willing to pay to get this company. If the goodwill is assuming that it's going to be indefinitely, then you'll be willing to pay this money to get a company. Any question before we do the part B? The floor is open. In my class, they will tell you, your understanding is what I need to make sure you understand the materials. So any questions? Any?
Professor, I'm sorry, could you just clarify
No.
the normal earnings for similar firms?
Okay,
Explain
good.
how you got that again?
Very good. So the normal earnings, the formula is that what is the similar company normal earning? You take the net identifiable asset, multiply by the rate, and the rate was given here. The normal rate here is 15%. So you take the company net asset. The net asset is your total assets minus your total liabilities. The total asset is right here, 7.5 million. The total liability is 4.4 million. So the difference between here give you the net identifiable asset. That you multiply it by the normal company rate of the 15%.
Okay, that makes a lot of sense. Thank you so much.
You're welcome. Now B said, okay, what if the extra earning is for the year, is going to be for 15%, and after 3 years, that income will vanish. That income is gone. You have to take the word, go to the table. I think I show you guys the table on this thing, but let me see if I can have the table here. Then we can read it together. I think I have the table here. Let me attach the table. So in our situation here, they mentioned 15% and 3 years. So you have to read it from here. This is the table. In your homework, you have to read from the table. Now, this is the number of the years. The years here is a 3 years. So you look at the 3 years here and you read the 15%. 15% is right here. So 15% of the 3 years give you This is a 1 year, year 1, year 2, year 3. Is give you this amount here. See, it's 250. It's a 2.2832. So you are going to take the 2.2832 and multiply by your excess earnings, your excess earning every single year. And that's what we did here. If you look at the Excel that we did here, give me, where's the Excel? Good. So if that's what you did here, so you take the 2.283 here, multiply by your estimated what goodwill. So this one is equals to, we are going to take this one here, reading from the table. So the estimated goodwill here is equals to your excess earning of the what 49,333 times 0.22823 here. This is supposed to be
Richard,
2. Yes.
it's 2.2832,
Yeah.
not 0.
2.2. Thank you. 2.28 323, right? So how much do we have?
112, 639. 112,
Good.
639.
So 1, 1, 2, 639. Remember, this is the goodwill you are willing to pay to get a company. You are willing to pay addition to your normal price you are paying. You are willing to pay this goodwill. Therefore, what is the implied value? What is the net identifiable asset plus your estimated goodwill? This is your estimated goodwill here. So we are going to take our estimated goodwill. So this one is equals to 7.5 million minus a 4.4 million to get a net asset plus the goodwill, right? Add your, sorry, not my, plus your goodwill of the what? 112, 639, 639 here. So please, how much do we have here? How much are you willing to pay for the company?
3,212,639.
639. This is how much you are willing to pay. You are willing to give this company, offer them an amount of what, 3 million, because to you, you know you are going to benefit from the future. You are going to get extra money every year, 49,333 every year is the extra money you are going to get. So you are willing to pay more money to get the company.
Professor, I have a quick question.
Of course.
For
Go
the
ahead.
estimated goodwill, are we multiplying the 49,000 with the percentage itself or just the number as a decimal? Does that make sense?
Very good. Yeah, of course. If the goodwill, if our excess earning here is going to last forever, perpetuality means that forever, then we are going to divide it by our return, which was given here as 25% of the return. If it's indefinitely, then we are going to divide it by the 25%, which so here, what we did here is that if you look at it, the formula here, we took the excess earning, and we divide it by the what? The, how do you call it? The 25%. So let me put it here so this one is equals to 49,333 divided by your return that you are going to get 0.25. That would give us the goodwill of the 901,97333.
Got it. Thank you.
Good. You're welcome. Any other questions before you continue the second part? Any question? Any? Okay. So let's look at exercise 1-2. Because chapter 1, there's only 3 exercises. If you look at this one here, the same. Alpha company is considering the purchase of Beta company, Alpha has collected the following information. You see here, the total asset is given, but look at it, it's a what? Total identifiable assets. So they have already calculated this for you that this is the what the total, this is the what liabilities, and this is the what the owner's equity. Now, this is the what the market value of the identifiable assets at 375. The liability is the same, there's no difference. Now, the cumulative total net cash earning for the past 5 years. So they are telling you, this one is that they are telling you that, hey, we have done this one. Let's go back here. We have calculated this average here. We have calculated this average, which this in one, you have to calculate it. We have done everything. And we are sure that this is what amount we are going to get as a earning for the 5 years period, including the extraordinary gain of 33,400, 500, and none of the what this one here losses of here. Alpha company expects a return of its investment of what 15%, assuming that the Alpha prefer to use the cash earning rather than a what accrual basis. So the company use the cash earning basis. We all know the cash earning basis versus the what accrual basis. Right? Accrual basis is the what? When the revenue are recorded, when expense are recorded, whether the money is received or whether the payment has to be made, the accrued. Cash basis is that bring your cash. I like that, like a Chinese food. Bring cash before we give you the food. That's the cash basis of the word accounting. So earning to estimate its offering price, and it estimated that total value of beta to be equal to the present value of the cash base earnings rather than the excess earning being discounted. So we are not going to discount it. They don't want you to discount the word based on the 5 years. Goodwill is then computed as the amount implied by the excess of the total variation over the identifiable net asset. So A, compute an offering price based on the information above that Alpha might be willing to pay. How much Alpha want to pay? B, the amount of goodwill included in the net price. B, compute the amount of goodwill actually recorded, assuming the negotiation resulted in the final purchase price of the what? This amount. So A, you don't want you to determine how much they paid. B here, they said, no, this how much they are willing to pay. Therefore, how much the what? The goodwill. How much the what? The goodwill. So let's do together part A here. Part A here, they have the cumulative. So let's start.
Is this is the homework gonna be based on this?
Yes, all the homework is based on this. It's the same questions, but the numbers are different. That's only the difference.
When is the homework due?
We are going to finish today. So you have, I think the homework is due on the 15th. I think I said the date already. I don't know if some of you have seen it or started it.
It's on the 15th.
On the 15th. Thank you, Debo. 15th. So we are going to start with the cumulative earning that talking about here. So they have the cumulative. Cumulative 5 years net cash earnings, because it's a cash basis. They are making, or let me put it here to make sense here, 425,000, which was given right here, was given to us right here. Then they have the extraordinary gain. It's a gain, therefore we have to what? Subtract. So let's, if it's a loss, we add. So let's extraordinary gain, which is a what? 33,500. Then add the total is a what? Non-reoccurring cash losses. add the what? The non-reoccurring. Non-reoccurring losses. Cash losses, which is 24,000. Those with the calculator, how much do we have here? So this is 5 years. So 5 years adjusted cash earnings is equals to those with the calculator. How much we have?
I got 415,500.
So 415,500. This is the what? The 5 years. Therefore, what is the average? Remember what we did. What is the what? The average earning. What is our average earning for the 5 years? So average earning, we are going to find the what? The average. Cash earnings for 5 years is equal to 415. 415 500 divided by 5. So averagely, how much are we going to get average?
83,100.
83,100. So when we buy this company, we know that averagely every year we are going to get at least the 83,100. That is the word part A. That is what they want you to determine. Now, that's why, so B said, okay, now estimate the what? The goodwill. Estimate for the goodwill for the present value here. So B here, part B, or A, let's put the A here. Offering, how much are we willing to pay here? So we are going to answer that question right here now. Why don't I put it here to make it easy? So it's going to be small. I can put it small and just make it, it's invisible. It's going to be invisible now. Let me take it. So let me put it A. So A, how much are we willing, estimated the purchase price? So Alpha amount informed Alpha might be willing to what to, right? The amount of goodwill included. So let's do the A now. We know that our estimate purchases price is equal to, we know the present value of, they told us that what, the 5 years right here is a 15% here, estimated 15% here for the 5 years. So let's go to the table and let's read. I want someone to read, but I want to make sure you guys understand the table. I need somebody to read from the table. It's 15%, 5 years. 15 years. So who can read it for us? 15%, 5 years. 15 and 5 years. So what will be
3522.
3.3522.
22.
Do you all agree?
Yeah.
Yes.
Okay,
Can you explain?
somebody.
Yes.
Okay, very good. You know, they saw that the number of the years is 5 years. Remember that the years is 5 years, right? When we buy this company, they're estimating 5 years period. So that is 5 years is right here. then it's for 15%. So if you trace here 1% all the way to 15% here, this is year 1, this is year 2, this is year 3, this is year 4, this is year 5. So year 5, the present value ordinary table is what? 3.522. That's where we get a rate from. It's good?
Yes.
Okay, so please write the number down as we are going to insert the number. So 3, okay. So this is equals to the 83,000, right? 100 multiplied by, is it what? You said it's
3.522.
5.
3.3522.
3.3522 here. Good. So how much
Professor, I
are we?
can't see the Excel sheet.
Oh, sorry. Thank you. I didn't share the Excel sheet. Thank you. It's good?
Yes, thank you.
Yes.
Okay, so how much do we have? So how much is this one now?
You're just multiplying the 83 times the 3.35?
Yeah, to know how much are we willing to pay.
And that's
278,000?
Like this?
Yes,
and that's the present
567.
5, 6, 7. So this is how much we are.
0.82.
0.82.
So let's make it 8, right? So if you run it, it's going to, is that 8? Is good?
Yes.
Okay, so this is how much we are willing to pay. We'll call the company, hey, we are willing to give you this amount. This amount we are willing to give. We are willing to give you an amount of the what? 278,568. Now, if you look at the B said something like, what if, look at the B, the amount of the goodwill included in that price. How much is the goodwill included in the what? In the price of the what? The assets. So we know already that first, you have to get the what? The net assets. Let get a net identifiable asset. So to get, there's 2 ways to do this one. I can just put it the word. First, look at the word, the price here. There's a price. So I can take the price and subtract the net identifiable asset. So there's a price here. So our estimated, you guys maybe you are going to see different in the solution, by the same thing, the same. So our estimated purchases price that we paid. This is purchase price. I just want to underline this here, which is a 278,560. Now let's let the word identifiable as a net assets, which we know called the market value of the asset, the 375, less the what? The liability of 160,000. So how much do we have here? How much do we have here?
215,000.
So minus 215,000. So how much are you willing to pay now? How much is the excess goodwill that is included on the amount that you paid? how much is the goodwill included in the amount that you paid. So your implied value of the goodwill, implied value of the goodwill of the company you are buying is equals to how much excess money you are willing to pay.
63,568.
63,568. This is the excess money that you are willing to pay in order to get the company. You are willing to, which means that here, that's extra money you are paying. This amount you paid was included the goodwill. And the goodwill is what? 63,568 was the goodwill that was included on how much you paid or you offered the company. I'm going to stop here. Any questions? In my class, I always make sure students understand. I can go back if you want me to go back. Should I go back
Yes,
or it's
please.
okay? Should I go back?
Yes, please. Not the
Of
numbers,
course.
but what it means.
Okay, very good. So remember, the first of all, you have to estimate how much averagely you are going to get when you buy this company every month. You buy this company, and we'll find out that averagely you are going to make 83,100 every year. That's the amount that you are going to make, 83,100. Okay, now the question is, at what extent are you going to expect this money? How many years that you want to expect this money? And the question said that you are expecting this money for 5 years. This is how much you are going to make for continuous 5 years, extra money you are going to receive for the 15% when you invest in the company. You invest in the better company. So what do? We multiply our excess earning cash we are going to receive here, multiply by our investment for 5 years for 15%, which means that we are paying them this amount. This how much we are giving to the better company so that we can buy the company. Is that one okay before I continue? It's good?
It's good.
Okay, now the question is, okay, what now if, how much goodwill did you pay, including this amount that you paid? Which means that you pay goodwill in this amount. So how much the goodwill? And to get the goodwill is always equal to the offering price you are paying, less the net identifiable asset. Less the net identifiable asset. The net identifiable asset means that your total asset less your liabilities. So what we did is that we took the net, and we are looking for the net identifiable asset here. What we did, we took the total asset. We always use the market value. Market value. So we use the market value of the asset is now 375, less the liability of 160. So our net identifiable asset is 215,000. Meanwhile, this is how much the company worth. The company worth or the value of the company is 215,000. And you are willing to give them 278,000. So the goodwill that you are paying to get the company is 63,568. Extra money you are paying
What's
to get the
goodwill
company.
again? What's
The
the definition?
goodwill is the extra money, excess money over the price or over the value of the company. The extra money that you are paying to get the company. So goodwill is the extra money you are paying or the amount that is above the market value of the company. So the company itself is 200, it's worth this amount, 215,000. This is how much the company worth. Any amount that you paid above this 215 is a goodwill.
So,
Professor,
Yes.
so basically, we are paying more money one time, and then we are calculating for 5 years how much we're gonna get it, right?
Yes. That's what we are trying to say that If every year we are going to get 83,100, then we don't care. We are willing to pay more money to get a company.
So it's just like a negotiating. We are seeing like how much we are paying more money to get a 5 years.
Very good. Very good. And that's what the company, they always do. They cannot just stand up and buy a company. No. They plan and look at the future of the company. They do all these calculations and look at the future of the company, whether it's worthy to buy this company or it's not good to buy it.
So it's like if we have like a less money of a loss and a profit, we see it. So we decided to don't pay it because like it's gonna be a loss for us in the future.
Very good. For example, you see this one here. Once we get this one here, and then our average earning here is less than the normal market, they said, no, we are not willing to buy this company because we are going to lose. Unless they agree that, okay, on chapter 2, we are going to see it called a bargaining. We'll tell them that, hey, we are not willing to give you this money. No, because we are not going to get any excess earning. Therefore, we are going to give you less money to get a company because we are not going to gain. It's good? Fatima is okay?
Yes, Professor.
Good. I think somebody was jumping in. Jason, are you the one?
Yeah, so I was just saying, like, comparing like goodwill, like let's say if you want to buy a car, right? If the value of the car, if it's like $2,000 and they're willing to give like more than that, is that considered goodwill?
Yes. If I'm willing to pay more than that, yeah.
Okay.
Yeah. For example, you go to the auction, right?
Yeah.
And you look at a car and you see that they are selling the car for maybe 5,000. You said, I can use this car for about 5 years. You compare to the market, and you saw that in the market, the car value is about 15,000. Meanwhile, these people are selling it for what, 5,000. So you'll be willing to buy it because you know it's going to benefit you, right? So you are willing to buy the car because you are paying less, more money, but because you know that the engine is good, it's going to run properly. Everything is going, so it's going to last you for a long time. Then I'll better go for that because I'm paying money though, but I know that it's going to last longer. So it's better for me to buy it.
Okay. Thank you.
You're welcome. Any other questions?
I have a question.
Yes, Lisa.
I'm confused with the estimated purchase price. I get how we got 83,100, but how did we get 3.3522?
Oh, good. It was here. They told us that, remember, they said that it's for 5 years, right? So we look at the 5 years and we are investing in this company and we want to accept a return of 15%. So we went to the table, which is provided on the Brightspace for your homework. We went to the table. We read from the 5 years here. You see, this is the number of the years, 5 years, right? Then we'll trace it to the 15%, which is here. And that gives us the present value of ordinary annuity of 3.3522. So we multiply our average earnings by the present value of the 3.3522. That is what gave us this amount. Let me go back. That would give us this amount of this amount here, the offering price of the 278,568.
Thank you.
It's good?
Yeah,
Just
thank you.
using the present value factor to get the present value of the amount that they will be receiving?
Yes.
Right.
Yeah.
Oh, Professor, just a quick question.
Yes.
I understand why we're reducing gain because the gain usually is like extraordinary. It's not usually happens every year. But why we have to add the loss?
Very, very good. Because remember, when you were doing the cash flow statement, you guys remember when you were doing the intermediate account, you did a cash flow statement, right? And you did the operating activities loss, activity session. Now, losses are not actually a loss, right? For example, if you let us assume that you have your cell phone, you bought the cell phone 3 years ago, 5 years ago, you paid $1,000. Every year you have to depreciate the what? Depreciation will become in for the assets for the phone. So you estimated that you are going to use the phone for 5 years. That's what you estimated. Now you use the phone 5 years. Your accumulated depreciation for the 5 years of the phone is $800. I'm just assuming. So here is the case: you want to sell the what? The assets, right? Your phone, and somebody said, "Oh, I'm going to give you that's $100. $100. So what happened? You lost $100, right? You lost $100 because by 4 years, your asset. Let me do something here. Let me see if I can do something here. If you want to give the asset up, you are going to debit the what? The cash that you are receiving, right? This is what happened. You debit the cash of the $100 you are receiving. You debit the what? Your accumulated depreciation on the phone for the 4 years is $800, right? You get rid of the phone, so you credit the what? The phone of the $1,000. What happened? You are losing. This is a what? Loss on what? On sale of what? The phone. Let's use the phone. You lost what? $100. The question is, did you actually lose this money? No, you didn't lose the money. The only that because it's a loss is that you get less money. So this loss here, you subtracted it from your net income. Remember when we were preparing the net income, we bought our net income. Then we said less loss, right? Loss. So if your net income is maybe 1,500, you are going to subtract this loss here of the $100, and then your actual net income is going to be 1,400. This loss actually money went out? No, there's no money went out, but it's a loss. So if you remember, when you guys were doing intermediate accounting on the cash flow statement, any loss, depreciation, losses and gain or anything, if there's a loss, we add it back because it was not money going out. So we have to add it back. And that's what we are doing here. The gain here is not actually mean that we get more money. It simply means that going back to what I just did here, the asset here, let me clear this first. Let me clear it. The asset here, we accumulated depreciation was what? But we received $300 when we sold it. So there's a gain here of the $100. This gain, which will be added to the net income here of 100 to give out the what? The 1,600. Actually, there's no money came in. It's just simply because the book value of the assets is less than the amount we receive. That is why it's showing that there's a what? Gain. Therefore, when you are calculating the cash to know the actual cash you receive, we subtracted it. That's how here we subtracted this gain here because it was added. Therefore, we have to subtract it to get the actual earnings. I don't know whether my explanation is okay for you.
Thank you.
It's good?
Yes.
Okay. Okay. So that's why remember here, when it was a loss, we added the loss here because it was subtracted. Therefore, we had to add it back. That's why here, when there was a loss, we added. It's because of the principle and the policy of the gap that actually there's a loss. Did you actually lose the money? No. It's because the book value is less than the amount you are receiving. That is why the loss occurred. Therefore, we have to add it to get the actual earnings. Now, let's look at the B part, the last part B here. Part B is saying that, okay, now what if? Part B said, okay, what if actually this is how much we paid? Then what is the estimated goodwill? If this actually how much we paid, then what will be the estimated goodwill? So we know that our estimated or the price, final price paid here. So estimated or purchases. Price, we paid here, we paid 315. Meanwhile, the net identifiable asset here, we know the net identifiable asset here is the amount of the what? 215,000. Therefore, how much is the goodwill? How much is your estimated goodwill, extra money you are paying to get the company? How much is your estimated goodwill here? Right? How much is your estimated goodwill? So our estimated or the implied value, our estimated goodwill included in purchases price is equals to, I think I can use this one, but somebody should verify for me. Is it 100,000?
Yes.
Oh, okay. Oh, I think this one, oh, I'm missing one number. This is a 500. 212. I miss all the numbers. I don't know why I get it.
Yeah, the purchase price is
Yeah, I don't know how I get the numbers from.
500.
So it's good, right? So that is the amount of the estimated goodwill. Any questions, please? Any questions?
No.
Okay. Now, I know one more is left. I always want to obey my time. I promise you guys 8:30 done. So on Wednesday, I'm going to do this last piece. Then we can start at chapter 2. Is that okay for you guys?
That's fine. Thank
Yeah,
you.
that's good.
That's okay.
Yes.
Okay. Okay.
Can you
So,
just quickly about the attendance? I'm sorry. Is there something we need to check in?
oh no, you don't need to check in. When I finish, I'm recording it. So the attendance after the class, I just go to the Zoom, go to reports, and I print out all those who attend the class. And that's why in the beginning of the class, let me do it again. And it's good that you brought it up. Please check the attendance. I'm going to attach the attendance. Check it and see if maybe you were marked absent, but you know that you were in class. So give me 1 second. Just use about 1 minute to go through the attendance here. This is the attendance. So please check it. If I miss anything, let me know. This is the attendance from the previous 2 meetings that we have had. This is the attendance here. Give me.
Can you scroll down?
Go down, right? Okay. Here, this attendance so far here. My concern is this student here. There are a couple of students, one, but I think is here today, so it's okay. That is okay now. But this Kumba here and also Celia here, these two students is my concern. Another one here, Shelly. I don't know whether they are in the class today. Another one is here, Steven, Kevin.
Can you scroll all the way to the bottom, please?
All the way to the bottom is okay here.
Okay.
It's good.
Yep. Thank you.
Okay.
It'll be added as
Come again.
be added as
Yeah. So I will see you guys on Wednesday. Please